Our mission is to bring together the best venture capitalists to compete so you have the insights on how to invest with the best. Let's start off with just some intros, who you are, what your fund focuses on. We could start with Darrel. Go ahead.
What's going on, everybody? How are you today? Awesome. So I'm Darrel. I'm an investor at Visible Hands VC. We're a pre-seed venture capital firm investing in diverse founders. So we focus on women and founders of color. At the pre-seed stage, we invest up to $500K through our various accelerator programs. Glad to be here.
Andrew?
Thanks. Excited to be here tonight. Andrew Gluck. I'm the founder and solo GP at Irreverent VC. Also really focused on the early stage, anything from pre-seed through seed plus, and really focus on e-commerce tools, technology, marketplaces, vertical SaaS, ad tech, and anything that kind of touches that digital e-commerce connection.
Nice. Jay Castillo.
Hi, there's two J's today, so yes. Jay Castillo, Jay Kapoor, so I'm the one with the C. It's a pleasure being here in front of all of you guys today. You guys all look so smiling and happy. I'm just happy to be here. I helped found MXV Capital. We're a debut fund, 50 million AUM. We invest in pre-seed and seed. We've invested in 14 companies so far, and we've incubated 2 out of the fund. So our fund's thesis is focused on really helping founders on the early stage company. Our GP brought a company from idea to IPO. So we really lean heavy with our founders and make sure that their success, because ultimately their success is our success. So I'm excited to share the platform also with 2 new fathers today. So round of applause for being here.
2 weeks away.
That's amazing. 2 weeks away. Well,
2 weeks away. 14 days. Still good.
But the anxiety's
but
still
the
there. So it almost counts.
Still here, yeah.
But pleasure being here.
Thank you, guys. Awesome. I am Jay Kapoor, the other Jay on this panel. Shouldn't have not sit next to each other. This is going to be very confusing for people. I am a co-founder and general partner of VSE Ventures. We are a $21 million seed fund. I'm based here in New York. My partner is in the Bay Area. We're founded on a very simple idea. It's gotten easier than ever to start a company, harder than ever for those companies to break out or get noticed. And my partner comes from a background in PR. He started a leading PR agency focused on startups almost 20 years ago. And I come from a background in media strategy. So our goal is to invest at the seed stage up to $500K and help our companies get noticed and break out. That's what we do.
All right. So let's talk about how this is going to work. We're going to go through 4 questions for the first round. And after every question, we bring up a QR code. Eric's going to hit a QR code. You'll see it on the screen. You'll scan that via Slido website, and we will vote who wins each round. So this is audience voting and see who the final 2 make the finals. So this is very important. Be interactive here, and they have to win the crowd, very much like Gladiator. You win the crowd, you win the title belt, all right? So this title belt is everything. It's very important, all right? All right, so let's get this thing kicked off. This is our 27th episode, by the way. Season 4, so it's pretty good. All right, so let's start off with a layup question here, all right? So what is the disconnect between macro economy and the tech economy? Why are certain fundraising stages for startups easier than others at time? And Mr. Kapoor, I'm going to start with you.
Okay, I'll take it from here. So I guess the thing you have to think about that is happening in the macroeconomy, or at least from where we invest and how it's trickling down to us, is just to think about human incentives at a time where there's a lot of uncertainty. And you can think about it all the way up to the LPs that invest in the funds that all of us run or work at. Those LPs, for a long time in 2021, were investing in both public and private, and public stocks were through the roof, so they all started shifting their money over to privates. They started investing in growth stage funds. Those growth stage funds then had so much money that they didn't really know what to do with it, so they started competing for deals, and the tier 1 funds got the deals they wanted, the tier 2 funds didn't. Those tier 2 funds started shifting down and started investing in Series C, and that put a lot of money at Series C, and that shifted down to Series B. And suddenly what you started having is these really big multi-stage, multi-billion-dollar funds coming down and leading seed rounds, which some of us would argue they had no frickin' business doing. So they're throwing around $5 million seed checks, and they're leading rounds, but they're not actually sticking around with the company. And when the tide goes out, you get to see who's naked, and that's exactly what's been happening in the market correction or what's happening in the ecosystem today. So to me, the disconnect is really that all of this capital that got funded in 2021 and 2022 is still out there in the ecosystem today. There's almost $300 billion worth of dry powder in venture capital. But the reason it's not actually getting invested is because those later stage funds, those $500 million funds, don't know when they're going to raise their next fund, because those LPs are dry AF. They have stopped allocating to private equity and to venture. And so if you don't know where your next fund's going to come from, you're going to slow down investing in any of those new deals. And because they're slowing down at C, the Series B companies don't know when they're going to get funded. So they slow down. And that starts to trickle down to what we're doing. The one thing that I would say is great at seed is that there were almost 800 new seed funds raised in the last 2 years. So there is a ton of capital for the founders out there that are out there. You just have to get over that hurdle with some of these VCs that are worried about whether or not they're going to raise their next fund. And so they're going to take their time allocating their capital, which they weren't doing in 2021.
Andrew, what are you thinking here?
Yeah, I think that's a really good overview and macro analysis. Yeah, I think if you're at the pre-seed or seed stage, companies are getting funded. I think diligence is taking longer. So if it used to take 1 to 3 months, it's taking 2 to 4 months. VCs are concerned they don't want to end up with egg on their face, investing in a company that doesn't really have any legs. And if you're out there, you need to just keep the momentum going and the growth going, whether that's growth on the product side, whether that's growth on the revenue side especially. Maintain that growth and make sure that you get to that point where you're, the new norm is not default alive, but default fundable, where you have this story that's fundable and exciting for investors to invest in, where you're not stagnating in terms of your growth. So, if you're pre-revenue or even pre-funding, how do you get from idea stage to MVP, maybe without raising capital? How do you get from MVP to first customers or beta customers or LOI signed? So it's really a lot about momentum these days, but the capital's out there.
Jay? Castillo?
I have to agree. I think this is actually a really, really exciting time to build a company. Number one, I think the market's contracting in a way and not deploying as easily pushes founders to be a lot more innovative. I can tell you over the past 2 years, we were seeing a lot of overcrowding in specific spaces and money, and all these companies were continuously being founded. And I think that what's exciting about this climate is that the companies that truly provide value add will stick around, and the ones that don't will falter out, which will almost kind of like slash and burn the existing ecosystem of where the tech space is at. I also want to add that and it's interesting, right? And it's crazy. When you look at the macro economy and the tech industry, when you look at the tech industry overall, there are very few players that really dictate and make up the success of the tech industry, right? And so no matter though, like right now we're in an economic slump, technology and innovation is continuously happening. And it's crazy because when you think about OpenAI, right, their release of ChatGPT, that in itself, just one product launch, has literally changed the landscape of technology. It's even accelerated where all these companies are today. And with the macro economy, they're a lot more susceptible to, government politics. When you look at just the overall macro economy, what it is, it's a summary of a country's GDP, inflation, unemployment. And with the tech industry, they're almost kind of standalone, because in these recessions, in these difficult economic times, everyone's trying to figure out, how do we systematize things? How do we make things more efficient? How do we not spend as much money? And the answer is technology.
All right. Darrel?
The answer is to add to things that everyone has mentioned. And contrary to the popular belief, checks are still being written. It's not like things just stopped. Founders are still receiving capital. And I want to just shout out to my friends at Bolster for one of our portfolio companies. They raised a $2 million pre-seed, which they also participated in. So we're excited to be co-investors with Bolster in Right C, founded by Brandon, who's one of our portfolio companies. But it really is understanding who has the money and how do you position your company and yourself to be able to capture the money from the investors. And that's by making yourself as investor ready as possible prior to actually trying to go out and fundraise. A lot of the times founders are just like, hey, I need the money, I need the money to get started, but they don't do the prep work to prepare a proper fundraising process, and they're just going blind. And when you go in blind, you get lost. So find people like us that freely give information. A lot of us are very active on Twitter. A lot of us put out free content and learn the process. And when you learn it, you'll be able to execute and successfully fundraise for your company.
Can I add something? This is the information age. You can do anything almost instantaneously. Like, you have a friend that can help you build a product. You don't know how to do something. You go online, you go to events. Like, information is at our fingertips, and I think it's exciting because if personally, at least, like through my lens, as a VC, if I see somebody who's bootstrapped, if I seen someone who's like not like, oh, I have an idea. Well, I mean, so do I. But if you actually move and you move the needle and you have traction and you've proven product market fit, or you have validation in terms of your customer base, that's exciting. We want to see something tangible. Like, I dream many things, right? I would love to be a zoologist, but like that's likely not going to happen. But if you have something that baseline tells me, like, I've done the research, I've validated the market, I have customers that are interested, and I've done this all by myself or with limited resourcing, that to me is, you are a scrappy founder, and I want to invest in you.
So essentially,
Darrel,
she's
hold on one
saying-
second. Eric, do you mind putting up the QR code? Just for the sake of time, I'm going to let you keep going. So just
essentially, she's saying builders get backed. Go
Yeah.
build something.
scan the QR code first. We got to get this going a little bit. You guys can talk in a little bit. All right, scan the QR code. We're going to start voting. And remember, the two that make the finals are going to go in the middle, so don't get hurt if you don't make the finals and you have to move your seat. But anyways, keep going on, Jay.
Yeah, so look, I was going to say, I think it's very easy for the four of us to sit up here and say checks are still getting written, right? But if you're a founder sitting here, that can be a very disheartening thing to hear. Because if you're in a process, you've been out fundraising for 3-4 months, you feel like, every VC, there's a lot of tire kickers out there, guys. I mentioned there's 800 funds that got raised in the last 2 years. A lot of them are kicking tires. They will happily take meetings with you. And I think the number one thing that I'm always surprised by when I am speaking with a founder is how few questions they ask me. So if there's one thing that you leave here with today, it is a two-way street. It should be. You hop on a call and the VC is the only one asking questions, you have lost a golden opportunity to actually validate whether this person is writing a check. Hey, what was the last check you wrote? How long ago was it? How many board seats are you on? Because there's a ton of VCs that are on 10, 12 boards a year. And so they'll happily take a meeting with you, and then they're going to hand you off to, sorry if there's any associates in the room, to an associate. Listen, I was an associate too. That's great. They're super helpful. But when it comes time to make a decision, whether they're going to fund you again, whether they're going to put a bridge in place, the associates don't have the power to do that. So you have to validate, are you actually somebody who is going to be here for me, who is going to write the check, who is going to show up for me? Or are you somebody who's kicking the tires? And if you are, thank you for your time. Thank you, next.
Erica, can we bring up the Jay? I know you want to jump in here, but let's see what the results are. You can talk while we go ahead, Jay. I'm sorry, I'm not like saying you could talk, but
Also,
I'm curious if we won here.
it's almost, it's perfect. Valentine's Day. Happy Valentine's Day, everyone. But it really is all about relationships. That's what life is about, right? It's a network. It's relationships, and ultimately, at the end of the day, I think it's, and to Jay's point, JK's point, it is really foolish to like jump in bed with an investor, right? Like, you truly need to understand, like, where is it like for me as a founder, if I'm starting something, where do my downfalls lie? Where do I need help? And knowing that there's a VC who has resources, who has the network, for example, your fund focuses on PR, right? So if you're a company that needs PR, like, you know who to choose. Like, it's about understanding the VC and what they're willing to do for you.
All right, we're going to cut the voting off here. Jay Kapoor took the first round. It was back and forth with JCast. I like that. That was fun. See, this is good. This is good. We got it going on. All right, so let's move on to the second question, talking about Chat GPT. Everybody's talking about that. That's fun to talk about. Obviously completely changing the world, the tech world. It's writing essays for people in college. That would have been nice when I went to college, right? It's a different time. Whatever. It's all right. So where do you see Chat GPT making the biggest impact now and in the future of tech by leveraging the AI? Andrew, why don't you kick it off?
Sure. I think we see a lot of companies these days leveraging ChatGPT 3 3.5, 4 coming soon, and really trying to just build like a UX and UI around it, which is interesting, and there will be some winners and opportunities there. I think the biggest opportunity is companies that are great companies that are building in a space and then leverage or embed ChatGPT 3 into their platforms, into their programs. I'll give a quick shout out to a portfolio company, Ngrow. What Ngrow does is it lets you A/B test different push notifications, so that for if you run a gaming app or a game app or a gaming or betting app, you could push notifications are one of the best ways to bring users back to the app and back to using the app. And what they've done is they've embedded ChatGPT features into the app directly, right? So before you could test 2, 3, 4 different types of push notifications. Now you have an idea. Okay, I don't need to open another tab. Open one of those tools separately. It's actually embedded and built into the function directly. And I think sales and marketing is an incredible place to be leveraging this in general. Generative copy, in addition to images, but really copy. You can really superpower salespeople, marketing people. A lot of this automation has been built, but kind of taking it to the next level of, okay, I'm going to put these people into a segment and a drip flow, and it's going to be automated. Instead, hey, I'm going to actually personalize this, but I don't have to go all the way to sitting down to writing an email for 30 minutes to get a response. I'm going to write the broad strokes, let ChatGPT take that and expound upon it, and then I'll go in and fix it up, and that will take 5 minutes instead of 30 minutes, but it'll be 10 times better than it would have been had you just kind of just leveraged an automated function that was the same templated kind of email to every single one. So sales and marketing, I think, and embedding is really where I see some of the big winners coming from.
All right, Darrel.
Yeah, and I think that this technology is very interesting for entrepreneurs. Like, what a time it is to be an entrepreneur. This is the best time to start a company. These technologies that are here using AI allows you to do things much quicker. A lot of times, even with ChatGPT, it helps you get like 80% of the way with simple functions. Like, I help founders create resumes. I help founders create like their job description when they're looking to hire people. And it's like, you can use these technologies and get the work done much faster, and you're able to achieve more with these simple technologies that make it much easier. So founders that are in the room, if you haven't already, begin exploring and testing and learning how to use ChatGPT and all these other AI technologies that are making it faster. Like, you're gonna get left behind. So start just finding different ways to learn and use it and implement it within your startups and companies today. Even if you're an employee at a company, like, you can actually use it to be more efficient at work. These are real practical tools that you can use in your everyday life. Like, every day I try to get my wife to use ChatGPT. Whenever she asks me a question, I'm like, oh, I don't know, type it in ChatGPT. And I have it saved on her tablet so that way she can start using it, because without someone like me in tech that's pushing her towards technology, she would never use it. But if you start making an effort on how can I use it in my everyday life, it's a tool that you can leverage to improve so many aspects of areas that you would never even think of. So just explore and find unique use cases for it.
Pretty soon his baby's going to be using it too.
She already has an account. My daughter is 5 weeks old. She has an account.
Got that early beta.
Yeah.
Mr. Kapoor.
Look, I think, how many of you are familiar with the innovator's dilemma? Yeah? Generally, I'm seeing some nodding heads, right? So I think the biggest opportunity for ChatGPT is Google's innovator's dilemma. Search something on Google today, the first 5 to 6 results are ads, right? And their business model is predicated on serving you something that you're going to click on that's going to make them money. And the big value that ChatGPT has for me today in my life is that I'm able to get the answer that I need without having to scroll down 6 things and not click on the wrong thing. And even the articles that aren't ads are ad-supported media. So you get in there, anyone ever try to get a recipe for chicken tikka masala? Scroll all the way to the bottom, and then that's after you hear the life story of the person cooking it, you finally get the recipe. This is all a function of the last 20 years of the ad-supported ecosystem. And so what's happening today, and I think the value that ChatGPT has, is it's able to cut through the noise. Where I think it's a little bit overblown, and people are really talking about, your job and your job and your job is going to be taken by ChatGPT. It's not. It's not going to. The big value that I see with the product is, the scariest thing in life is a blank page. And so if you're a creative staring at a blank Word doc, it's really hard to get started. But if you start with a paragraph, it unlocks a level of creativity that it wouldn't have if you were starting with a blank page. And so I think that's the real benefit. Whether you're a coder, you're a writer, you're a public speaker, you're whatever it is, starting with an inkling of an idea is so much better than starting with a blank page. And that's where I think the tool is really powerful, but ultimately it is a tool. It's not going to take somebody's job.
Jay Cass.
I'm going to come clean. I think I have an unhealthy relationship with ChatGPT. I do. I think what's really interesting is when you think about what AI is good for right now, it's very much process orientation. So, and also objectivity, right? When you think about what people write, it's through whoever's writing its point of view. So it's interesting when you look at industries that require communication and back and forth, specifically in going back to kind of your point, sales and also customer success, not only are you automating a lot of the process orientation, which a lot of jobs are doing, but also you're able to do it in a way where you can communicate a lot better, right? And I think that that's really exciting. I think also when you look at kind of forward looking, number one, a lot of, and it's funny, right? You go to college, you spend, I don't know how much, if you're lucky, under $20K a year, and then you become a Salesforce administrator. Like that's the reality, right? And there's nothing wrong with Salesforce administration, but it's very tactical. Like the human brain is beautiful and we're capable of so much more. And so when you think about how all these process-oriented things are now being automated by ChatGPT, imagine what we can do in the future. What I'm excited about is when ChatGPT starts, as much as I hate saying it, understanding us, because we can then communicate better with each other. If I wanted to talk to you, sir, right, and I communicate a certain way and you listen a certain way and we have a miscommunication, ChatGPT can be the intermediary between that. When you think about learning, right, the way that we learn right now is very much copy-paste. That something needs to change because ChatGPT will be taking over those types of jobs, right? And so at the end of the day, the ability, I think, for ChatGPT to customize, to help us learn better, to help maybe with mental health a lot better, and to really be able to allow humans to level up in a sense, and then think about really amazing, important, strategic things versus the everyday, methodical, like process in, process out. That's what I'm excited about.
Eric, can you put up the QR code? And we're going to continue this. I guess the question, keep going with this, is like, what's the most creative way that you've used it, or like personally?
Wait, so we had a RevOps dinner last night, and there's a CEO, Zafar, if you're out there, shout out. He is the CEO of Growthster, and it is a RevOps. It's a RevOps agency, and he spends $20,000 on productivity tools. And what he told me was that literally GPT-3, he's done a whole thing where he's outsourced his whole BDR function through ChatGPT. He uses Airtable, LinkedIn, like web scrapers, and it has been able to basically outsource a whole arm of his agency, which is really cool. And on top of that, he built and now productized it into a new product, which is really cool. So, and again, I understand, like for me, I'm not gonna lie, also, coming clean, I'm coming clean a lot today. I published a blog post, and I'll reference it later because one of the questions is in reference of it. But I wrote it. I was like, I think this is what I want. I shot it in ChatGPT. It like made it a lot prettier. I did a few edits, and like that's it. Something that probably would have taken me hours took me a lot shorter. Yep.
I, much to my wife's chagrin, tried to name our baby using ChatGPT. I gave it parameters. I'm like, no, don't end it in SH, and wanted to be 6 letters long, and wanted to be
My daughter's birthday, it was birthday on Tuesday, is Sydney, which is supposedly like one of the names of Bing's new chat search function. So it,
Listen,
who knows? Could work.
It gave us a short list. My wife rejected all of them, so unfortunately, I can't say that my child is going to be named by ChatGPT, but that would have been really cool. No, I can't share the name yet. I can't.
Yeah, not yet.
How do we name it? My wife came up with the name. That's how we got the name.
That's how it works.
I also told Charlie, just for the fanfare of it, I was just gonna plug all the questions in ChatGPT and then just completely repeat what it gave me, and at the end be like, and that was ChatGPT, ladies and gentlemen. So.
We'll add a fifth seat right here for ChatGPT.
Right.
Seems a lot like Cyberdyne or OpenAI
like
Cyberdyne.
Watson.
How are we doing on the votes? Can we bring up see where we're at? See how.
I feel like I should do better on this one than last one, right?
I hope so. Start giving
A
out.
little better.
Jay's winning again. Jay probably invited the most people. That's typically how it works.
That's it. I just tweeted it out. Some of y'all showed up, so thank you.
Yes, it's a cumulative vote though, so it looks like we got two upfront winners right now. So you guys are in the, you know where you stand.
There we go.
And we like that way it's
Some
moving.
movement.
We're at 26 people that are voting. It seems like we got more than 26 people. So just to put that in there, we want to be a little more competitive. We see this,
Can I vote, or is that not legal?
Yeah, you can if you got a phone. I mean, that's fine. It's all right. All right. Well,
Jay Kapoor, what do you think about?
Why not? I don't want to vote for myself on this one. So.
yeah, right. Well, it doesn't
Wait, are
matter.
you?
Let's move on. Valuations. Next question's around valuations here. All right. So, how should a pre-seed startup think about their valuation during this type of market? Do you go with the new normal or stick with the valuation you had or you currently got? Darrel, what do you think about that?
Yeah, so this is a topic that I speak about publicly on Twitter a lot. So a lot of people, especially at the pre-seed and seed stage, have a wrong misconception of how valuations are determined. Valuations aren't something that, hey, I'm about to fundraise, I want to raise money at $6 million valuation, and you have decided that today because my friend down the street in his startup, he raised at 6, so I want to do 6 too. That is not how valuations are created. Valuations, especially at the pre-seed and seed, are a function of supply and demand for the desire of your equity. Investors determine what your valuation is based on who wants to buy it. And it's a marketplace, it's a competition of who's going to bid the highest and provide the most value to determine the valuation. So I always bring back to founders, how do you get more investors at the table fighting for your equity? And that takes for you to run a process, like I mentioned in the beginning, and not just haphazardly fundraise. Being able to understand the steps from A to Z on the process of fundraising and executing on it, being investor ready, is how you achieve the highest value or optimal valuation, because if it's too high, that's not optimal. You can actually raise at a too high valuation that actually puts your company in a bad position for the next round. So it's not about raising it as high as it can. It's not a competition. You're building a business, and you need to be optimal about your valuation.
Kapoor?
The four of us are the wrong people to ask about how to value your business. It's like asking a wolf what the right price of lamb chop should be. It does not make any sense. The problem is, if you're going to ask a bunch of VCs, we're going to say, well, you should do it at the lowest clearing price, right? But for you as a founder, that may not be the price that you want to raise at. So talking specifically about pre-seed, the right way to think about it, and I try to counsel founders think about it, if you're raising your first round of capital, you've raised no capital before, you're typically going to float about 20% of your equity. If you're going to float about 20% of your equity, take a look at how much money you actually need to hit those next milestones. So let's say it's $2 million. You feel like, hey, I can stand my MVP up and I can get a couple of pilot customers in, start generating some revenue with $2 million. Okay, so now you're floating about 20% of your company for $2 million. You're looking at around a $10 million valuation. Now, to Darrel's point, you can actually drive that valuation up if you get people bidding for it. But again, to what end, right? So consider for yourself that you also need to be attracting employees into your business. And for a startup employee, coming in at an early stage at a low valuation is really attractive. Coming in at a really inflated valuation that you have to grow into is not attractive for their shares. Think about all the companies in 2021 that raised massive rounds, Fast, Bolt, whatever. There were executives that were leaving really cushy, jobs at FANG to come work for these companies, but their equity was underwater from day one. So don't just consider the valuation of your company as something that, hey, it's going to make a great headline for TechCrunch, or hey, I'm going to get to call mom and dad and say, hey, I raised it at a 25 or 30 million, pre-revenue, pre-traction, whatever. You're also thinking about putting yourself in a hole when you're going out and trying to attract really talented people to come work for you. So your valuation should also take into consideration how you're actually building your team and how you're going to incentivize them to come work for you.
Jay Cass.
Those are all really good points.
Good answers so far. I
Those
appreciate
are very
these
good
answers.
answers, exactly. Well, I also think it's interesting. So in terms of term sheets that are issued, there's three things, right? Like there's the founder, the founding team, there's the total available market that you're going after, and then there's your product/idea, right? And ultimately, at the end of the day, I think, and to Jay's point, at the end of the day, raising more money early on, you're taking more loss in terms of your ownership of your company. I don't know about you. There's, I didn't say this, but as a VC, I see some of these founders grind so hard. You guys are putting your time, your life, your energy, your money into this company. And ultimately, if I were in founder shoes, I would want to get with my product as far as possible and give the least amount of equity to VCs as I could. But the reality is, at the end of the day, the market does end up shaping up the terms that you get. And as much as you want, lofty valuations aren't exactly a positive thing either. And I think the thing as a founder that you can do is really just strategically position the way that you're fundraising, make sure that your product is in a great place, test out your pitch with VCs that you're not too excited about, but also compress the fundraising time. I'm not gonna lie, like as a VC, if I see that you've been fundraising for 6 months, like immediately you're like, okay, why hasn't this person been funded yet? And ultimately at the pre-seed stage, what you're trying to do is get to an MVP, but that traditionally takes about 6 to 9 months. So be realistic. How can I be as scrappy as I can with a limited amount of cash in order to get to the next stage? And going back to your point is at the end of the day, when you raise your next round, there are revenue multiples that you have to hit. And if not, you're taking a down round later on. And that's not ideal for you, your equity, or the valuation of your company, or fundraising moving forward. So.
Good answers, good answers. Andrew.
Sure. I think one area that a few of us have talked about has been this process and running a good process. So just to kind of jump off that point, a good process means, like Darrel was saying, you're ready and you're kind of ready to be funded. If you're out there and you're just, I want to get funded, I'm going to events, I'm trying to meet people, that's great. But VC fundraising is just like any other sales funnel. You wouldn't just, go to events and just try to strike up conversations or just randomly reach out to people if you were trying to sell your product. You do this, you do your research, you do your homework, you create a list of VCs that fit the mold, that are buying the product that you're selling, whether that's the sector, whether that's the geography, whether that's the stage that you're in. Go ahead, create that list. A lot of VCs are open to cold inbound, myself included. Warm intros obviously help a lot more. If you can go ahead and do that, go ahead and try to find those warm introductions. If not, try to build a relationship and rapport directly. A good cold inbound email helps. I have a cold inbound form on my site. I read every single one of those that gets submitted and reply to every single one. Does it help when a founder also sends me a note and says, "Hey, by the way, I submitted my form. Here's like a few more bullet points on the startup." It's definitely a positive in my mind. So it's definitely something I like to see. And then in addition, if you can't reach out and find a warm introduction, building and crafting a really good cold email is important. Figuring out what makes me exciting and attractive as a founder, as a company to get funded, and then keep going with the momentum. Follow up. You don't hear back from a VC, follow up. VCs get a lot of pitches, get a lot of inbound. There's nothing wrong with following up until they say stop. I'm not interested. Be aggressive out there. Add them to your investor updates list. VCs do it all the time to founders, to other VCs without their permission. Go ahead and do it. We'll unsubscribe if we want to. But be aggressive, maintain the momentum, and don't be afraid to reach out with updates.
Nice. Eric, can you put the QR code up? Anything else that we missed here with the valuations that you guys want to jump in with? Darrel?
I could add just a point that I like to make a lot. I think VCs make founders work too hard. And a lot of it is arbitrary to what actually is related to company building. And the most important thing that founders are doing is focusing on serving their customers. But VCs want you to go through these hoops and obstacles to get this warm intro, to make them feel excited about their company, as opposed to like, hey, I am a VC. I like to find great businesses and great founders that are solving real problems. Let me do the work to find out about your product, about your team, about your company. And hey, even though you didn't understand what a proper valuation for your stage is, I'm going to go and do the work to educate you, as opposed to giving you a strike because you used the wrong word in your pitch deck. I think VCs make founders work too hard, and it should stop.
This is a separate note, but I think it's really important to know. Unfortunately, with social media, we are each a brand. you can be the smartest person in the room, but unfortunately, if not a ton of us know, we're not going to know otherwise. So I think what's also really important is contributing to your field, whatever it is that you're building, showing that you understand the space, showing that you're advancing the space, whether that be Twitter, whether that be blog posts. I know everyone's on that train. It's time consuming. I totally get it. But when you think about the massive amount of people that exist, someone that has a track record or a footprint that they care, they've been doing this for a while, or they're interested, they're learning, they're advancing, they're educating. That's really important to us. That means that you're well-networked.
What stage do you recommend founders start doing that at?
Well,
like start putting content out and start building?
Well, I think it depends on like what the actual founder's desire is, right? Like, so for me, who am I, right? But what I'm trying to do is I have a very unique perspective that I feel like I want to share. There's no end goal per se, but I realize that there's a gap of education in the market. And so I want to start conversations. I want to start building community around these things. And I think if, like, for example, we have a shout out to Jordan Singer from Diagram. I don't know if you guys know him. He's really well known in the product space, was a product designer for Cash App, really passionate about design, and has been publishing things, starting side projects, starting conversations, building community. The second we saw him, like, we almost didn't need to see his product. We're like, this guy lives and breathes product, and whatever he's building is going to be amazing, because not only does he have the network that's helping him build it and is likely going to consume it, but this is his bread and butter and runs through his veins, you know?
I think, at the earliest stages, you're pre-seed, seed, you're investing in the company, but you're really investing in the founder and the founding team, right? So many teams pivot into adjacent things. They pivot from B2C to B2B, but you're really investing in the founder at the end of the day. And so building that kind of brand track record that, just like a designer, if they're trying to get hired, they'll share their portfolio. It's similar.
Yeah, I disagree with that. I actually think that falls in the category of what Darrel said, which is making founders do too much work. It's not your job to educate the market. It's your job to educate your customers. And if it's going to lead to sales, go ahead, put the content out there. But if you're putting content out there to catch the eye of a VC, it's ass backwards. Like, that is not what you should be doing, because what catches the eye of a VC is traction. So if you're putting that content out there and it gets to your customers and you get the traction, then you're going to raise. But if you're sitting out there to try to build a public presence, you're like that dude from Fast that was tweeting out like how he takes 6-hour showers. Like, that's not the content you want out there. And frankly, we do PR with our companies. We don't recommend that they do that stuff until there is actually a product in market, until they're getting towards that Series A raise. So if you're pre-seed, seed, which I'm guessing a lot of founders here are, my recommendation is don't do that stuff. Focus on one thing only, which is getting to your customers. And if you get to your customers and you have the traction, then that's what the VCs will care about.
Big win for Darrel here. Big win. Big win, Darrel. Andrew had a 0 at one point. That was tough.
Should have invited more people.
It's all right.
No term sheets for you.
I should note, too, after this, we're going to go to a bar. I think it's on 26th Street, but we'll tell you afterwards. And everybody can go out there, potentially pitch some VCs, meet some other founders. It seems like we got a good group of founders and VCs in here. Let's move on to the last question before we move into the finals. More focused around CEOs, pre-seed CEOs. So obviously CEOs on the larger scale, it's harder to make big moves. We're seeing Google do this. We're seeing Satya Nadella of Microsoft do this, implementing Bing, ChatGPT with Bing, right? So it's harder to make that move and move that ship, I guess, so to speak, as you get in a bigger stage. But on the pre-seed side, what are skill sets needed that you look for in a good pre-seed seed CEO that will translate, or hopefully translate, to make a good leader in the later stages? So Jay Cass, kick us off.
I just wrote a blog post about this featuring ChatGPT. I think a huge thing is, the reality is when you're pitching at a pre-seed or seed stage, it's very likely that your product is going to adapt, to mold. And ultimately, that adaptability in a founder and in a founding team is super important. When you look at the velocity of technology, it's moving so quickly, and at any given point, technology is driven based off of consumer and business needs. And so if your business or your target consumer or business shifts and their needs shift, you need to be able to quickly adapt to that. We know, or I've seen founders that are just like tied dead to their, they won't hold off of their product for dear life, and the market is changing and evolving, and they need to change and evolve with it, and that's really important. Second, ultimately VCs are looking for a return on investment. So what we're looking for is a really big vision, not what I'm interested to understand what you're building today, but I also want to understand what you're building tomorrow and the day after that. What happens if there's new technology that comes and disrupts? Like, what are you planning to do then? Like a founder that's quick on their feet, that has vision, and is able to do that. Number 3, businesses are people businesses. Like, businesses don't run without people. And so at the end of the day, the ability to lead and to communicate is so important. There are amazing and brilliant founders out there, but if people don't want to work for you, I'm sorry, you can't be a team of one and run a company. And I think that's the reality of it. And I think that's, for the most part, lastly, is the winning mentality. Listen, if there's any founders out here, like, building a company is tough. You run into roadblocks, you have to pivot, like, things happen, like, things get thrown at you. And at the end of the day, a lot of successful founders, it's the tenacity to move forward. You look at these massive CEOs and founders of these corporations, you read their books, you read their blogs and their TED Talks and everything that they put out there. But you realize that a lot of them had to overcome adversity, and even when you have a penny in your bank, you still have to have that winning mentality of, I believe in this, I will push forward, and no matter what, I will get through that. And those are the key foundational things that we look in founders.
Okay. Andrew, what do you think?
Yeah, I think for me, one of the biggest ones is communication. Things shift very quickly and very fast in startups, so being able to communicate a clear vision, both externally and internally, is wildly important. So that you have your team working on the things that are most important, so that they also feel comfortable coming back to you with the feedback that they're getting from the market, from the customers, and being a great communicator is wildly important there. And another one is the best companies ship, right? Whether that's small little updates, whether that's quick updates, whether that's the MVP. There's always the exception to the rule of the companies that spent 4 or 5 years, building and designing. I think Canva was one of those. ChatGPT was one of those in a way, working on that for 8 years. But most often, the best companies are out there shipping changes, getting feedback again from the market, from their clients, from their customers, and adapting very quickly.
Kapoor?
So look, I've been investing exclusively at seed stage for about a decade now. And from the founders that I've worked with, the only consistent thing that I've seen is that the best CEOs do only 3 things: set the vision, hire the people, make sure there's enough money to keep doing 1 and 2. That's it. If you are doing sales, you are only doing sales until you can grow to a point where you can hire someone to do sales. If you are doing marketing, you're only doing it until you can hire for it. But I bring up the sales point because it's always top of mind for me, because those 3 things that I mentioned, set the vision, hire the people, make sure there's enough money, all comes down to the founder's ability to sell. So what I'm evaluating when a founder is pitching me is how they sell. Because how you sell anything is how you sell everything. And we talked a little bit earlier about the fact that most people make the VC pitch one way. You're here and you're like, ask me questions, I'm ready for it. And the best salespeople, what they do is they qualify. Number one thing that good salespeople do is they sit there and they ask the target questions. And if they realize that this is not the right person for them, they move on, because the most precious thing for you as a CEO, for you as a founder, is your time. So I notice that when somebody's asking me questions, because they're qualifying me and they're qualifying their time. They're putting a dollar value on that time. And I say, okay, if they're doing it with me, they're probably doing it with their customers. They're probably doing it with employees that they're trying to hire. And they're setting themselves up to build a good company. And then the last thing that I look for in that hire the people is their experience in terms of hiring, in terms of scaling, in terms of managing. Look, there's a lot of first-time founders out there, but that doesn't mean that you're a first-time manager. You've probably worked at a company before, you've managed a team. And it doesn't even mean that you've managed a massive organization. You maybe just managed 2 or 3 people. But I want to understand, were you good at it? What did you learn while you were doing it? What kind of leader are you? Are you somebody that is really micromanaging? Are you somebody that's sort of very, sits back and waits for communication? I try to get to know the founder, I try to get to know the CEO as somebody who people would want to work for. And so if they can sell, and they're somebody that people want to work for, then that gets me excited to invest.
Darrel?
Yeah, so for me, it all comes down to service. If you go to my Twitter, the top pinned post that I have, it says, VCs, our jobs is to serve. We serve founders. We serve other VCs. We serve our LPs. We are servants to the startup ecosystem. And I'm looking for founders that see their customers with the sole intent to serve them. And that level of servitude is how you deliver value to solve their true pain points and their problems. If you're worried about growth, if you're worried about revenue, if you're worried about these startup metrics that can get you funded, you're focusing on the wrong things. The one and only important thing is to serve your customers, and I'm looking for those founders that are servant leaders and just focused on that service.
Let's bring up the QR code. You guys keep going. This is a round of applause there. All right, Darrel. Maybe you're going to win this one here. QR code's up. This is the last one before we make the final, so everyone should get a vote in here. Pretty important. I'm going to move this belt right into the middle seat just so you guys know that's where the finals are. But go ahead, Jay Cass.
No, I was just going to say that that's exactly it in terms of the topic that we were talking about before is the relationship that VCs have with their founders, right? Like the early days are going to be the hardest days, and you want somebody that you can trust, someone that you can rely on, someone that's there for you. And ultimately, what's really funny is we have some investments. We always ask about our relationship. We're like a new fund, so we're still paving the way. We're building the foundation. We're trying to define ourselves in like a really important and exciting way. And sometimes we talk to our portfolio companies and we ask them like, what is your relationship like with like the other VCs, right? And oftentimes they go, they sometimes hop on like a quarterly call. They ask us our numbers. They're like, what's your burn? What's your ARR? And it's crazy to me because at the end of the day, if they succeed, we succeed. And it's a very symbiotic relationship, and VCs that approach it like it's independent.
Yeah, what's wrong with asking for metrics from your
No,
portfolio
it's fine,
companies?
but I'm saying if that's the only support and the only time that you go and help them.
It's the only thing they're doing.
It's the
Okay.
only thing
Got
they're
it, got it, got it,
doing.
okay.
And then maybe they'll say, hey, talk to this guy. But at least the like how we're building the fund is I'm in there, but like we Slack, we call, we text. Like if a founder's down, I literally text them. We like ship them gifts. Like we're sitting in working sessions and like literally tearing apart their UI.
I want to be a
We're going
portfolio
frame per
founder of
frame.
yours.
Yeah.
Huh?
Said I want to be one of your porcos.
Oh, there you go. Well, if you ever start a company.
But I do monthly calls, sometimes biweekly, at least monthly, in addition to text and email in between. But with every portfolio company, and I end every single call. What are your biggest obstacles? What can I do to help? Is it a connection? Is it listening to your event? Is it talking through an employment issue? Are you recruiting for a job? Like I want to know what are your top 2, maybe 3 biggest issues, and how can I help and support you?
Also, sorry, quick shout out to you. My friend saw that we were talking on the same panel. She goes, I guess you're an investor in the company she works for. And she goes, he's amazing. I love him. He's like super hands-on.
Vote for me.
Shout out for being a good VC.
There you go.
No, seriously, that's awesome.
VCs congratulating each other. There we go.
On the sense of those of you that do have VCs that you're talking to, shipping them gifts is lovely. Ask your VCs to ship you customers. Because that's ultimately the no. Look, I think it's nice. Look, I think it's nice to build your brand. It's nice to do all that stuff. But ultimately, the number one thing that our founders come to when we ask, hey, how can we help? Send me customers, man. Yeah. Send me revenue.
Yeah.
And ultimately, that's the number one thing. And then hires, right? The other piece is, hey, send me hires.
But also, I mean, yes, we obviously do customer introductions and investing. But also, founders are people. Founders actually suffer a lot more higher levels of depression than most people because it's a stressful job. And ultimately, yes, we are helping you build your business, but also we want to make sure that founders are okay. And I think that takes relationships and really exciting and just like really interesting touch points because I think being a founder is a very lonely thing, right? When you look at, unless you're in a community where it's only founders, like, well, then that's great.
One thing I want to see in VC is for VCs to be nicer and more approachable to founders that they don't back. Of course, we're going to be nice to our portfolio companies because if they hit big, we hit big. But what about those that we have no equity stake in? We have nothing to gain from communicating with them. We should be nicer to founders.
What do you think VCs could do? Because I'm actually really curious about this topic as well. Like, what do you think VCs should do more for the founders they're not going to back?
So VCs should be more engaged with founders, even if they're not going to back them, by providing advice, insights when they reach out. Just the single thing that you can do, you get hundreds of DMs on Twitter and emails, you can actually start replying to them.
So
I like this.
One of the biggest frustrations that founders, especially founders that look like me, that are out of network, that do not have the community of investors that can back them, the biggest frustration they face is that they can't even get to talk to a VC because no one wants to reply to their emails. No one wants to tell them that, hey, you sending me a wall of text is not appealing. So they go around for 3 years sending out this big paragraph of their pitch to VCs, and the first VC that they pitched should have just said, hey, let me show you how you should actually do cold outreach. Here's a link to a resource that someone else wrote. I didn't even write it, but here's a link to this resource. Why don't you check out how to write a cold email?
We are running up on time now. That was Jay took that round. Now, I got a text, and the two winners who are moving on to the finals are actually the two on the outside. So you guys are actually going to have to both flip seats. So I like this. A lot of action.
All right.
But I will ask
Swapping
Andrew
mics.
and Jay Cass to help out with the. You could help out with the banter. I would appreciate the banter. But we are going to do a little bit more rapid fire because we have about 10 minutes. We have about 10 minutes here before these guys can be nice to you at the bar, and you guys can pitch whatever you're pitching. So let's start off with the first question, hot deals. So hot deals push VCs to skip steps in their due diligence process sometimes just to win those hot deals. I think we saw that with FTX. Yeah, right? You guys, we've all seen that. So how do you avoid falling prey to this type of circumstance? Are there any sneaky red flags that are not being talked about, but essentially the diligence period, and how do you avoid it?
Sure. So I can start by demystifying of why this actually happens. So the incentive structure in venture capital is totally wrong. For VCs, when and there's a term called being consensus or non-consensus and right, that's when no one else believes in a deal, and you're the only one that believes in it, and then that deal actually blows up and becomes the next Uber. That's being non-consensus and right. You are rewarded when you do that. That's great. You should be rewarded. The problem is when you are consensus aligned with everyone else, all the other VCs, and you're wrong, there's no repercussions for being a part of the crowd of everyone. Hey, everyone thinks it's a hot deal. Instead of being challenged to go find deals that no one else is looking at and being penalized when you are non-consensus and wrong, you are, as an investor, you're incentivized to actually just be a part of the herd. So the incentive structure of VC needs to change and to have a structure that actually rewards investors for taking risks. Because no one has lost their job because they invested in a company that everyone has invested in. But many VCs have lost their job because they invested in a company that no one invested in but failed.
Jay, what do you got?
Yeah, look, your fund size is your strategy, and so the way to stay disciplined is to stay disciplined to your strategy. And so if that means that, okay, we're a $21 million fund, we're going to write 36 checks out of our fund, and we have communicated to our LPs that this is a 10-year vehicle, right? So the mistake that happens with a lot of these funds is when they try to shortcut the function of this asset class. If our LPs were looking for quick returns and quick hits, they would go and invest in the stock market where there's liquidity and they could have a quick upside. They're investing in us because, at least at the seed stage, we are an asset class that is supposed to be volatile in market shocks, right? And so as a result, they need to be ready to sit for that time period. So to Andrew's point earlier, if you communicate with your investors, if you are confident in your strategy, if you're confident in the things that you know, right? My grandpa, up until the age of 83, 84, was investing, until his last days, and would always tell me, invest in what you know. And if you don't know it, you don't invest. And that simple thing to me is, there's a lot of cool stuff out there, generative AI, biotech, blah, blah, blah. If I don't understand it, if I can't wrap my head around it, it doesn't matter who the lead investor is. It doesn't matter what Stanford triple MBA, PhD, MD the founder has. It doesn't matter because I don't understand it, and there's no way that I'm going to be able to defend it to my investment committee and to my LPs. So the way that you avoid that FOMO is that you're confident in your strategy, you communicate your strategy, and you stick to your guns when you don't understand something.
Let's keep this moving. We're not going to do the QR code until the very end, and that's when we're going to do one big vote for who's win.
Can I add one more thing?
Sure.
I think that's part of the problem why so many black and brown people don't get funded, because the investors that are out there do not look like them, so they don't have the same problems as them, so they don't understand their solutions. The fact that they're basing their investment thesis on, I invest in what I know, you don't know the same things as these founders. So it's automatically, you're not gonna invest in these founders. And that creates this huge funding divide that I wrote about last year of the disparities of the founders that are not getting capital. It's because the system, as it is today, needs to be flipped on its head, and we need to get back to serving founders.
Yeah, I mean from a technology standpoint, though. I don't mean from like a founder's background standpoint. Obviously, that's a very different thing. But if it's a complex technology that you don't understand that a hot round is being done in, that's when I would say you don't invest.
All right, so next question. As VCs swing from one hot investment trend to the other, you got NFTs last time, crypto, AI sounds like it's popping up now. What are the pressures that VCs feel from their LPs to land a deal in these flashy categories, and how do you navigate those pressures?
Let me start this
Jay.
one? Yeah, your LPs shouldn't be setting your strategy as a fund. They're limited partners for a reason. So, our LPs will ask us questions about it. Hey, what do you think about this trend? But at no point is any LP sitting here and saying, hey, man, you haven't done a generative AI deal in 2 quarters. What's going on, right? Because that's not their function. And if they're interested, look, we have 84 LPs. A lot of them in our fund are individuals or founders that exited or folks that are executives and they did well for themselves. Part of what they're investing in us is to learn. They want to learn about these new technologies. They want to learn about these new categories. And so the pressure that we feel is really more to educate than to invest. And as long as every quarter I'm putting out a report where I'm saying, hey, here's what I'm seeing happening in generative AI. It's this new hot buzzword that you're hearing about. Here's what we think is investable in this category. Here's what we think is not. And I think as long as you're being, again, come back to my point from the last one, confident in your strategy and you communicate to your LPs, then that pressure isn't going to push you to do certain kinds of deals. And to the point of VCs swinging from hot trend to hot trend, well, the reason they do that is, to Darrel's point earlier, because the incentives are wrong, right? If you invest in a hot trend, that hot trend gets marked up by the next round of VC. You got a lot of markups in your portfolio. Looks really nice when you go raise your next fund. And what happens is you go raise your next fund, but what was happening in fund 1, well, that crashed. So your fund 1 actually didn't return anything, but who cares? You're on to fund 2, you're on to fund 3. And I think that structure, fundamentally, I think LPs are changing. When you go in and you have a conversation with them, they are looking with high scrutiny at what your markups in your funds are. And so I tend to see, as I talk to LPs, as we went through our fundraise last year, those conversations are changing. They're looking at my past track record over the last decade and seeing, hey, were you just trend chasing? Or did you actually invest in a deal that was here for the long run? And I'm happy to see that at least those questions are being asked.
Yeah, to add, I think it's super important for any emerging fund managers or future emerging fund managers, when you're going out to raise the capital from these limited partners, that you have a plan, you have a thesis, you have an actual thesis that you're going to stick to regardless of how the market changes after you set that thesis. Because if you're just chasing after a hot trend after, and don't really understand how it aligns with the thesis that you actually raised the money on, then you are just throwing money out in areas that you actually have no clue what's going to happen with it. You need to have discipline regardless of what the market is saying, and be your own free thinker. For us at Visible Hands, we invest at the pre-seed stage. And I talk about pre-seed and seed. The knowledge that you need to be a great pre-seed or seed investor is more related to company building. In the later stage, it's more related to finance and understanding the different financial models that can help you understand what the valuation should be based on the metrics and traction. So really understanding your strategy, your thesis, and just cutting out the noise. There's a lot of noise in VC, and it's important just to stay focused on what really matters and set that expectation to your LPs and deliver without swaying.
Breaking into venture. Last question, breaking into venture. What's the best hacks or cold outreach someone trying to break into venture maybe that you received or you heard? Any story that is fun, please share.
Yeah, I could just stand up and just be a testimony for breaking into VC. So I'll be short, but growing up, I didn't know anything about venture capital. My father was an entrepreneur from Jamaica, came to this country with nothing and built his businesses. And growing up, I helped him build I built houses, and it was just working hard with him day in, day out in his businesses. So entrepreneurship was all I knew. Graduated from undergrad in 2015, and 2 years later, 2017, is when I learned about venture capital. And I learned from reading a book called Why Should White Guys Have All the Fun by Reginald Lewis. It's the story of the first black billionaire, or the first black person to own a billion-dollar company. And he did so by successful leveraged buyouts, or what we call now as PE, private equity. After reading that book, that's when I learned about venture capital and this whole industry of high growth tech. So since 2017, I did everything in my power to make myself as well-rounded as possible, to get the networks I needed, to get the experience I needed, to be able to eventually break into VC. So it took me 4 years from the day that I read that book to break into VC in 2021, a week after graduating from my MBA. And it really takes you to have a vision of the future and for you to execute on that vision and really understanding what is the higher thing, what is the thing that you're doing this for, and creating alignment with your life. For me, that alignment is my passion for closing the wealth gap. There's huge disparities on the people that have money and the people that do not have money in this country. I think that entrepreneurship is a unique opportunity to change that paradigm who have wealth. And through venture capital, the people that are enabling entrepreneurs, I think it'll be possible to have a major impact in closing the wealth gap. So for me, I say that I'm in year 4 of a 20-year journey to launch my own fund and to be able to close the wealth gap through entrepreneurship. And that's why every single day I do what I have to do to drive that impact.
Hey, inspiring stuff. Yeah.
And you're going to do it, man, with the passion that you have. You're going to do it. So, look, the answer that I used to give 5 years ago, I don't think is relevant anymore. Because 5 years ago, it was about build a presence, build a brand, pick a category and become the expert in it, start a podcast and start doing TikToks. It's not relevant anymore because there's just so much noise out there. And I think what I've realized from some of the best, associates that have reached out to us, and we've hired one person, and I hope in this coming year we'll hire some more. Nothing speaks louder than founder testimonials. When a founder reaches out to me and says, "Hey, man, this was a summer associate, or they were between jobs, but they spent 3 months with me, and they were helping me out in this," and dude, nobody sells like this guy, or nobody, puts a pitch deck together like this guy, or this girl, or they changed our whole strategy approach. They spent 3 months with me, and I walked out of it feeling like, wow, I have a much better understanding of where this business needs to go. I would work with them in a heartbeat. I tried to hire them. I couldn't because they want to go be a VC. Nothing speaks louder than a founder testimonial. So if you're looking to break into VC, you have a skill set today from what you've been doing. Maybe you're in consulting. Maybe you're in strategy. Maybe you're in banking. The skill set that you have today, you can go and share that with founders and, find time. We all have more time in the day, except for new fathers, than we realize. And you can say, hey, I can dedicate 10 hours a week, maybe my weekends, my nights, that I can dedicate to working with this company and see who those companies, investors are. And once you've done a good job for them, say, hey, could you put in a good word with your lead investor? Because that, to me, speaks volumes, because that's not hypothetical, that's actual. And that really matters a lot when I'm looking to bring somebody onto my team.
Can I add one more thing? This is a
Yeah,
very
yeah.
important
Just get the
topic.
votes in right now. We're gonna get kicked out of here soon, so just get your votes.
When it comes to breaking into VC, the advice I give a lot of people looking to break in, I speak to a ton weekly. I make myself very available to people seeking to break into VC because I know how hard it was for me. When it comes to breaking in, it's 80% your network and 20% of what you know. So the 80% in your network, why it's super important to do what you're doing today, to meet people within the industry, within the entire startup ecosystem, is because the network gives you the opportunity. The network brings the opportunity to you. Then your knowledge and your skill set, the other 20%, the leftover 20%, is what allows you to close on those deals. So you have to network and be able to open the door for those opportunities, then the 20% is the skill set so you can close on them. So the 4 years of me learning as much as I can from VC, building companies, investing in companies, going back to school for my MBA, volunteer hours at accelerator programs, backing different organizations to helping them in their missions. All of that was just 20%. It was most of my time, but it was 20%. But ultimately what allowed me to get the job was the network that presented the opportunity. But the 4 years of work, when the opportunity came to my doorstep, I was able to close because I put in the work. But 80% networking and 20% your skill.
Eric, can you put up the results? I think we only have 20 votes in. Yep, 20. So I don't know. I guess we're tied right now. I don't know what that is. What's going on there? Do you know what that is? There we go. All right. There are more than 20 people here, so I mean, before we leave off, and we'll let the voting continue to go. Andrew, do you want to say anything, on what's been said, or any of the questions that?
Yeah, I think on the breaking into VC, listen, it's hard. It's not easy. I tried to do it myself. I tried to, interview for roles, had those conversations with folks while I was, angel investing, and ultimately ended up starting my own fund because I couldn't break into VC. I'm not saying that's necessarily the route to go, but I think one area is do the job before you do it, which means helping founders, which means finding companies and connecting them to investors, which means helping founders hire people, making those connections, helping founders get revenue, and those are the things that you can do. At the same time, protect yourself. Like, there's a lot of people in the community, not intentionally, but will take and will not founders, but VCs will take pitches and will take information from you and will let you kind of work for free. So make sure that you're protecting yourself while you do that.
Jay Cass, any final words before we go to Smithfield on 22nd Street? 26th Street.
You almost sent us to the wrong place.
Yeah, right.
I think I agree with Darrel. Similar story, first gen, whatnot. Had a difficulty breaking into VC, and ultimately at the end of the day, I think it's, and this is what I was saying to you before, if you are a VC, and going back to your initial point, we are servants kind of to the startup industry, or at least we should be. And whatever skill it is that you're honing in on, the ability to kind of be able to communicate that in a good way, to understand how operations work. It's interesting, and I'm not poking at any VCs that have never been in operator roles, but it's hard to understand what a business needs to succeed and understand the grit and the hard work that goes into building it and how to build it from the ground up if you've never actually worked in one. So at the end of the day, for the operators out there, I think a huge part is, yes, refining those skills, understanding where your strong points are, communicating that well to VCs, and ultimately it is networking. It's knowing the right people. It's going to these types of events and really building those relationships, because when it's time, ultimately, with anything, you need to lean on the people around you.
Darrel, pick up that belt. Looks like you are the winner. Congratulations. You have the dais, my friend. Go ahead. You got anything else you want to say? Victory speech, anything that you want to say that wasn't said today, feel free. And then we'll go to Smithfield.
Well, thank you so much for voting for me and your support. I'm just happy that you all are here today, because without you being here, none of this would be able to be possible. And it's with your engagement, with the community that's being built here, the organizers for putting this together, the sponsors for putting this together and supporting the vision of what's going on here. We all are here because we love entrepreneurship, we love startups, we love this ecosystem, we love this industry. So continue to fellowship, network with one another, and build meaningful connections that last beyond today. Connect with as many people as possible on LinkedIn and Twitter. You'll be surprised, and I guarantee you, I'll put money on it, that if you connect with at least 10 people today, 10 years from now, you will at least see some form of value from at least one of those 10 connections. So, but that value cannot be created if you don't connect today, because once you leave this room, you'll probably never meet them ever again. You have this one opportunity to connect with other people here. Make sure you take advantage of it. And connect with me, Twitter and LinkedIn. Please. I would love to meet all of you. That's it.
All right, connect at Smithfield, 26th Street.
He'll be the one with the belt. It's easy to find him. He's got the belt on.